Ever wondered how a simple street in New York became the nerve center of global finance? Uncover the story behind Wall Street, the world's financial powerhouse. In this video, we'll delve into the rich history of Wall Street, tracing its journey from a humble street in New York to becoming the nerve center of global finance. We'll explore its origins, the significant events that shaped its influence, and how it has weathered numerous crises, including the 2008 financial meltdown. As many of you already know, New York is the world's leading financial city. The high evaluation of New York's financial competitiveness is due to the fact that Wall Street is located in New York. Wall Street, an approximately 1.1-kilometer-long street in southern Manhattan, New York, is not only a place but also a metonym for the U.S. financial markets. Although Wall Street is a place name, it is often used to refer to the U.S. financial market. Wall Street is home to the New York Stock Exchange, the world's largest exchange, with a daily trading volume of over $17 billion. It also hosts NASDAQ, various banks, investment banks, and large financial institutions. Additionally, the New York branch of the Federal Reserve, the Central Bank of the United States, and the world's largest gold storage facility are also located on Wall Street. Because of the concentration of financial companies with global influence on Wall Street, any problems on Wall Street can shake the global economy. The financial crisis that hit the world in 2008 also began on Wall Street. How did a simple street evolve into the epicenter of global finance? The history of Wall Street dates back to the colonial era of America. New York, where Wall Street is located, was first introduced to Europe by the Florentine explorer Giovanni da Verrazzano in 1524. Then, in 1609, as the Dutch West India Company expanded into the New World, the number of Dutch settlers began to increase. And the Dutch settlers named the area New Amsterdam after the capital of the Netherlands, Amsterdam. This means that New York was originally a Dutch colony. Since the Dutch settlers took over the area where the indigenous people lived, tensions escalated. The indigenous people constantly attacked New Amsterdam day and night in an attempt to reclaim their land. At this time, the Dutch settlers built a 2,340 feet high wall on the northern side of the settlement to protect against the attacks of the indigenous people and the invasion of the British. Then in 1699, the British advanced into the Manhattan area and completely occupied New Amsterdam. The British named it New York after the Duke of York, who was the British Empire, and removed the wall built by the Dutch. Although the wall was gone, the name remained, and the street where the wall stood came to be called Wall Street. In its early days, Wall Street was one of the residential areas in the southern tip of Manhattan. In 1711, after New York City established the city's first official slave market on Wall Street, approved by New York City, the once ordinary Wall Street began to change. Many people gathered at the slave market, and New York City made a lot of profit from the sale of slaves by taxing everyone who bought and sold slaves. Not only New York City but also those who supplied and traded slaves made a lot of money. As the number of wealthy people increased due to the slave market, finance began to develop, and around this time, a financial market was formed on Wall Street. However, it was only a financial market of a certain scale, not yet as large as it would become. Wall Street became nationally known beyond New York starting around the end of the 18th century. In the 18th century, America was not yet an advanced nation in terms of securities, finance, and the economy as it is today. The global leaders in the economy and finance at that time were the United Kingdom and the Netherlands. Until the end of the 18th century, the financial center of America was not New York but Philadelphia. At that time, there was no stock exchange in America, and the form of securities trading and fees were not standardized. Then, in 1792, 24 stockbrokers in America gathered on Wall Street to establish guidelines for stock and bond trading, and signed an agreement to establish the New York Stock Exchange. They established two trading rules: transactions were to be conducted in a joint office, and the fee would be 0.25%. Since they had no office at the time of the agreement, the 24 brokers signed under a sycamore tree on Wall Street, and the agreement was named the Buttonwood Agreement. Based on this agreement, the New York Stock Exchange was founded in 1817, formally approved in 1863, and the present New York Stock Exchange was born. Subsequently, Wall Street emerged as the center of global finance. In 1889, the stock report, the Wall Street Journal, named after Wall Street, was founded, and it has since become one of the most influential economic newspapers in the world. In 1884, Charles Dow and Edward Jones, editors of the Wall Street Journal, devised the Dow Jones Industrial Average to track overall market activity. Additionally, with the opening of canals and the development of America's first power plant on Pearl Street, the commercial center of America shifted from Philadelphia to New York, specifically to Wall Street in Manhattan, in the 20th century. Around 1918, the world's top financial center shifted from London in the United Kingdom to New York. The background to America surpassing the United Kingdom as an economic superpower was the First World War. America joined the war in its final stages and became one of the victorious countries, enjoying the special economic boom brought on by the war. The warring European countries bought food, ammunition, and supplies from America, and even borrowed money, making America, which had been a debtor nation before the war, the world's largest creditor nation after the war. Subsequently, during the economic boom that lasted for about 10 years, America experienced what is called the Roaring Twenties. In the 1920s, the spread of automobiles and the establishment of cinemas led to the birth of Hollywood stars. And with the holding of sports competitions and beauty contests, miniskirts became fashionable. Companies engaged in mass production, consumers engaged in mass consumption, and the era of automation and mass culture began, with many Americans becoming enthusiastic about jazz. Furthermore, the development of penicillin appeared to free humanity from the fear of viruses. At that time, there was a pervasive trend in America of living life to the fullest as if prosperity would last forever. The American stock market was also booming, and a significant portion of the profits generated through economic growth, including the redemption funds from Europe, flowed into the stock market. This was largely influenced by the direction set by the United States. At that time, the U.S. was beginning to emerge as the world's leading economic power. The country aimed to structure its future around high-value-added industries. This is one of the fundamental reasons why the U.S. manufacturing industry is considered weak today. Labor-intensive industries were classified as low-value-added industries, while fields such as financial services, insurance, advanced industries, semiconductors, information and communication, biotechnology, and fashion were considered high-value-added industries. With the support of economic growth and the national-level financial industry, the daily stock trading volume and stock prices in America reached new highs by the late 1920s. Stock prices continued to rise so much that some predicted a sharp downturn. But people ignored these warnings, and the stock market inflated beyond its actual value. The Federal Reserve Board, the central bank of the United States, raised interest rates 3 times in an attempt to cool down the overheated stock market. But the upward momentum of the stock market showed no signs of slowing down. Meanwhile, ominous signs began to appear in the summer of 1929. Due to the economic downturn, companies' expected earnings started to decline. However, the Dow Jones Industrial Average continued to rise daily. This was because the American stock market had already transformed from an investment market into a speculative market. Nevertheless, even a speculative market is closely tied to the real economy. The fact that stock prices continued to rise despite the economic downturn and rising interest rates indicated that someone was ignoring the signs of an economic crisis and continuing to supply money. In reality, institutions sensed the abnormality. However, despite the reduction in institutional investment, individual investors, caught up in the optimism and overheated atmosphere, poured their money into the market, driving stock prices higher. Economist Irving Fisher analyzed that stock prices have reached what looks like a permanently high plateau, while Roger Babson remarked at a luncheon for financial professionals on September 5. Sooner or later, a crash is coming, and it may be terrific. Their predictions became a reality in October, about a month later. Stock prices began to fluctuate significantly in early October, and on Thursday, October 24, the Dow Jones Industrial Average started to plummet. This day marked the beginning of the Great Depression in America and came to be known as Black Thursday. 4 days later, on the 28th, stock prices plunged another 11.73%, leading to what was dubbed Black Tuesday. These were part of the massive stock market crash known as the Wall Street crash. The Dow Jones Industrial Average experienced repeated ups and downs and fell to half its previous level within just 2 months. But the decline did not stop with stock prices. Individuals who had invested in the American stock market lost their entire fortunes, and many people were plunged into extreme poverty. Since Wall Street had already become the global financial center, the crisis on Wall Street was tantamount to a global economic crisis. In the 1930s, the entire world fell into the Great Depression. The specifics and duration varied by country, but in the shortest cases, the Depression lasted from 1929 to 1934. While in the longest cases, it extended until 1939, just before World War II. In 1929, the U.S. unemployment rate was 3.2%, but by 1933, it had skyrocketed to 25%, and the situation where more than 1 in 5 people were unemployed persisted for over a decade. In response to the worst economic crisis in history, the U.S. implemented a modified form of capitalism known as the New Deal. The United Kingdom and France responded to the economic crisis by forming bloc economies that grouped the world economy, while Germany, Italy, and Japan, as fascist states, became engrossed in territorial expansion. In other words, the Great Depression caused the collapse of the stable system that had existed after World War I. It is also seen that the aftershocks of the Wall Street crash led to World War II. The Great Depression was fully resolved after the war. The United States surpassed its position as the leading economy, becoming the most powerful nation in history, and firmly established itself as the world's #1 power. While the Wall Street stock market once again regained its vitality. However, Wall Street faced multiple crises even afterward. The most notable was the financial crisis that struck global financial markets in 2008, as mentioned earlier. After the dot-com bubble burst, a period of low interest rates ensued to stimulate the economy, leading to an increase in the number of people buying homes through loans, which in turn drove up housing prices. As housing prices soared, everyone began borrowing money to invest. However, the problem arose when financial institutions started lending to subprime borrowers who had no ability to repay. Moreover, derivatives were created that allowed investment in these borrowers. These products promised profits if the borrowers repaid the money but incurred losses if they defaulted. At that time, these products were sold under the banner of low risk, high return. In reality, as long as housing prices kept rising, there was no risk. If borrowers couldn't repay, they could simply sell the house. However, it was impossible for housing prices to keep rising indefinitely. When the number of people buying houses, or in other words, taking out loans, reached its limit, housing prices stagnated, and as the number of people unable to repay their loans increased, housing prices began to decline. Financial institutions found themselves unable to recover the loans they had extended. Derivatives became high-risk, low-return products, and individuals and companies, including the 150-year-old investment bank Lehman Brothers, who had purchased these products, went bankrupt one after another. As a result, the subprime mortgage crisis triggered the global financial crisis of 2008. Moreover, the repeated shocks to the global economy caused by Wall Street led to a growing resentment toward Wall Street. In the fall of 2011, protests were held under the slogan, Occupy Wall Street. Additionally, numerous documentaries were produced, and there were even claims that Wall Street was a gambling den betting with other people's money. In essence, the root cause of the financial crisis was the moral hazard of Wall Street, driven solely by the pursuit of money. In U.S. presidential elections, Wall Street became one of the most important issues, with debates about the crisis on Wall Street, the relocation of financial centers, and the decline of Wall Street. However, in the end, Wall Street retained its position as the world's financial center. As long as American capitalism thrives, so too will the influence of Wall Street. Since most of the companies on Wall Street are global corporations, there is a prevailing view that the U.S. government can no longer interfere with Wall Street. Moreover, the decline of Wall Street would be the same as the decline of the American financial industry, so Wall Street's power is unlikely to diminish. This concludes the discussion about Wall Street, the world's financial center. Thank you for watching. Don't forget to like, comment, and subscribe for more insightful content. Take care and see you in the next video. Goodbye.